Imagine this, it's 1998. The internet is exploding, and every investor is convinced they've found the future. Companies with barely a product, so long as they had .com in the name, are suddenly worth billions. You throw all your money into a few shiny tech stocks. For 2 years, your portfolio climbs so fast that everyone asks for your secret. But then the year 2000 arrives, and everything collapses. A points drop never before seen on the US markets. Traders and investors are shell-shocked. Even Bill Gates loses $1.8 billion in a single week. When the bubble burst, the Nasdaq fell nearly 80%, and only 48% of .com companies survived. I watched friends lose millions in a blink. The internet really was the next big thing. The problem wasn't technology, it was the hype, the overconfidence, and the belief that the rules of investing didn't apply anymore. Now here's where it gets interesting. Fast forward to today. That same energy, that same mania, is back. But it's not the internet this time. It's AI. People are calling it a once-in-a-lifetime opportunity. Maybe they're right, or maybe it's history rhyming again. John Templeton said it best. The 4 most expensive words in investing are, "This time, it's different." So, is this time actually different? Let's break it down. Right now, the fate of the stock market and your portfolio is being decided by just 7 companies. Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, they make up around 36% of the S&P 500. That alone should make you pause. Even if you only own 1 share of an index fund, you're already betting heavily on them. Here's the first reveal. These companies are locked in a global AI arms race, and the scale of their spending is staggering. Tesla plans to spend $5 billion on autonomous driving and XAI. Elon Musk's AI startup. Apple is investing $10.7 billion to make Siri smarter. Meta is putting $60 billion into data centers and the metaverse. Google is rebuilding the internet with AI at a cost of $75 billion. Microsoft is funding OpenAI and supercomputers with $80 billion. Amazon is spending $100 billion on AWS infrastructure to own the backbone of AI for everyone else. That's a total of $330 billion in a single year, more than the GDP of countries like Finland or Portugal. And this spending may be the main thing keeping the US economy afloat. Without it, we might already be in a mild recession. Global AI spending is expected to reach $500 billion by 2026, with electricity and infrastructure demand topping $3 trillion annually by 2030. The stakes are astronomical. The IMF estimates that 60% of jobs in developed countries are exposed to AI disruption. Whoever cracks these systems first could control the next century of economic output. And Mark Zuckerberg has said it bluntly, if Meta ends up misspending $200 billion, it's worth it. Falling behind isn't an option. But here's where it gets even more intense. The race isn't just corporate, it's national. The US and China see AI as the key to global dominance. Billions are being burned to ensure they hold the reins. So, where is all this money actually going, and who's benefiting the most? This is the second reveal. It starts with the chips. Intel, AMD, and Nvidia design them. Companies like OpenAI and XAI buy them. Then data centers Oracle and CoreWeave buy more chips to lease computing power back to AI labs. On the surface, this seems normal. But the flow of money quickly creates a loop that inflates revenues artificially. Microsoft gave OpenAI $58 billion. OpenAI paid that back to Microsoft to use data centers. Microsoft used that to buy Nvidia chips. Nvidia invested back into OpenAI. Each company can record that money as revenue, boosting stock prices. Think of it like paying a friend $1,000 to dig a hole, then getting paid $1,000 to fill it back in. If valued like OpenAI at 40 times revenue, that dig and fill loop would make both of you worth over $40,000. Obvious simplification, but it captures the point. The loop escalates. OpenAI announced a $300 billion deal with Oracle. Oracle then buys tens of billions in Nvidia chips. Nvidia invests up to $100 billion back into OpenAI if OpenAI buys more chips. The winner? Nvidia. Their stock is up 1,600% since ChatGPT launched. They sell chips to Microsoft, Meta, Google, Amazon, Oracle, and OpenAI, and then invest back into the same companies. Demand looks huge, but part of it is artificially fueled by the cycle itself. Here's the next reveal. Nvidia sells the shovels, Oracle owns the land, OpenAI digs the quarry, And together, they convince the world there's gold under the soil. Even though no one has struck it yet, OpenAI is valued at $500 billion, but earns only around $12 billion in revenue. They lose money every month. That's the fundamental problem. AI services aren't making enough profit yet to justify the hype. But there's potential. ChatGPT alone has over 700 million weekly users. That's a tidal wave of attention and a goldmine of data. Imagine ads inside conversations, product recommendations, or even subscription services. Then there's the adult content announcement for verified adults. Not my area, but it's massive. And the biggest lever of all, replacing human labor. Corporations will rely on AI, creating a captive market for pricing power. But here's the catch. All of this assumes AI progress keeps accelerating, and that leads us to the data wall. AI has improved insanely fast over the past few years. From crude videos to photorealistic content, investors assume this will continue. But we're approaching a limit. The data wall. AI has consumed nearly all public online data. By 2027, it may have eaten almost every scrap of human-generated content. Imagine a ladder in Snakes and Ladders. Everyone assumes it climbs forever. It doesn't. Progress may slow dramatically. Centuries of books, research, and writing have fueled AI's rapid growth. But to go further, AI will need different types of data. Humans learn from experience. AI only learns from what it can see, read, or interact with. So, scaling past the data wall is not trivial. It's possible, but only with new methods of learning. Until then, expectations may outpace reality, and that's when the bubble could burst. So is this the next .com bubble? Not exactly. There's a key difference. AI companies today have real utility and a path to profits. .com companies mostly had names and hype. But the signs of a bubble are there: overvaluation, circular revenue loops, geopolitical mania, and scaling limits. The truth? We don't know where we are in the cycle. It could be the start of a decade of investment. Or we might be closer to the peak than anyone realizes. So what should you do? I'm not a financial advisor, but here's my take. First, keep investing. Automatic monthly investments in a broad, low-cost index fund can be one of the most powerful habits you form. During the dot-com bubble, I continued investing even when my portfolio dropped. The market eventually bounced back, as it always does. The secret is not panicking. Consistent investing through downturns is often the most profitable move. Second, increase your income. More income equals more fuel for wealth. Promotions, side hustles, and additional revenue streams give you the power to buy opportunities when the market dips. Third, diversify. Avoid putting everything into one asset class. My portfolio includes stocks, bonds, gold, real estate, and cryptocurrency. Dividend-paying stocks can be especially valuable. They generate cash even in downturns. Here's the takeaway. If this bubble bursts, it won't be the end of the world. Knowledge gives you power. If you understand these cycles, you won't panic, you'll capitalize. That's how fortunes are made when others run for the exit. The AI boom is extraordinary but fragile. The stakes are immense, and the future will reward those who see both the opportunity and the risk. If you found this useful, make sure to hit the like button, subscribe for more insights, and turn on notifications so you never miss a breakdown on the markets and AI investing. Thanks for watching.